I bet you hate paying taxes like everybody else in this world. Well, in this video, I'm gonna go over 12 tricks on how to pay less taxes in Canada. Hey, what's going on? It's Chris here from Wealth Awesome. Everybody hates taxes, am I right? Well, with the top 10% of earners in the country paying 54% of the total income tax, it clearly doesn't matter if you are rich or poor, barely making ends meet, or raking in heaps of cash. The Canada Revenue Agency, or the CRA, will come for their piece of your income. After years of helping to prepare taxes for friends and family, the only thing I've seen that makes this financial obligation a bit more bearable is finding as many tax breaks as possible. If you want to learn how to pay less taxes in Canada, I hope these tips will help you out. Stick around until after the list is finished and I'll go over my personal thoughts about paying less taxes in Canada. If you get lost or want to learn more, you could check out the written article about this video on my wealthawesome.com website. I've included its link in the description. Here we go with number one. Number one is childcare expense. If you have children, you can deduct childcare expenses from your tax bill. So if you and your spouse work and no one is home full-time to take care of your child, you're probably paying a lot of money in daycare expenses. While it's a necessary expense, you can lighten the burden a bit by claiming these expenses on your tax returns. The spouse or parent with the lower income has to claim these expenses on their returns. You can claim up to $8,000 a year for a child aged 7 or younger and $5,000 for children between 7 and 16 years of age. You can claim daycare, nursery, nanny, caretaker, day camp, day sports school, and overnight boarding school expenses. Make sure you ask for both a receipt and the social insurance number of these service providers. Second tax break is spousal RRSP contributions. You can lower your tax obligations by contributing to a spousal RRSP. If you are in a higher tax bracket than your spouse, you can maximize your tax break by contributing to a spousal registered retirement savings plan, or RRSP. Your contributions will not affect the available contribution room that your spouse or common law partner has. There are two benefits of this method. If your spouse earns less than you do and is in a lower tax bracket, they can't get a tax break as big as yours, even if they fully contributed to the RRSP on their own. Also, when your spouse finally withdraws from the RRSP or RRIF, which stands for Registered Retirement Income Fund, they will be in a lower tax bracket than you and will pick up a lighter tax bill. Third tax break is claiming medical expenses. Several medical expenses that are not covered by your insurance are tax deductible. If you or a dependent incurs medical expenses that aren't covered by your insurance, you can claim them on your tax returns and lighten up your tax bill. Many of these expenses could be pretty hefty, like full-time and specialized care, prosthetics, insulin pens, hearing aids, eyeglasses, contact lenses, and vitamins. You can claim the entire amount on your tax returns. For some of them, you may need a medical prescription to claim the deductions. Number 4 is to donate generously and in a smart way. Donations are a non-refundable tax credit and can reduce your tax bill. Donations can help you earn both provincial and federal tax credit and even help offset your tax bill. It's not only the tax credit on the current year's donation that you can claim, you can also even claim the tax credits for donations that you made up to 5 years ago. The important thing here is that you have proof that you donated to eligible entities. Since it's a non-refundable credit, you should only use this deduction for the years where you can expect your tax bill to be higher. A smart move is to donate securities that have accumulated capital gains directly. So if you've had stock or something that has increased a lot in value, you could donate that entire amount, then you won't have to pay any taxes on capital gains and your tax charitable credit will be a bit higher. Number 5 is to split your pension. Splitting pension with a spouse or common law partner can reduce your taxable income. You can split with your spouse your Canada Pension Plan or CPP pension by up to 50%, depending on how long you have lived together. The pension split makes sense only when you are 60 and older, as your income and tax bracket or your spouse's income and tax bracket is higher than yours. By splitting the CPP both ways, the spouse with the higher tax bracket can lower their taxable income. You can also split your RRIF income, but the rules for this one are different. Number 6 is to transfer your tax credit to your spouse. Some federal tax credits can be transferred between spouses. If your spouse or common law partner has certain tax credits, but their tax obligation isn't high enough to be canceled out to zero when they apply all the tax credits, they can actually transfer the excess to you. These expenses include funds for tuition, education, textbook, pension, disability, age, and caregivers. This can help the high-income spouse offset their tax obligation, which can then result in an overall lenient tax burden on the couple. Number 7 is the home office tax credit. Working from home can make you eligible for significant tax breaks. For self-employed individuals, home office expenses can also be a decent amount of deduction. You could even claim the portion of your home that you use as your home office on your tax returns. You just have to use square footage as a basis. For example, if it accounts for 15% of your total space, you can claim 50% off of your utilities, insurance, mortgage interest, and property tax. You could even claim part of the wages you pay to the person who cleans your home, for example, or stationary expenses, but you can't claim capital expenses, so be careful of that. Number 8 is to employ in-house. Hiring your child and spouse can lower your tax obligation. If you run a business and you want to increase your business expenses enough that you can lower your taxable income, a smart way is to hire your child or spouse to do work for you. Be warned though, this is something that the CRA monitors closely. Also, you can't just pay out a salary to your family members based on a pretend position. They must provide a valuable service to the business, even if it's as your assistant, and they have to be compensated fairly within market guidelines. So you can't pay your child like $50 an hour to do some basic data entry or something like that. That won't fly with the CRA. Number 9 is to incorporate. Once your business income grows beyond a certain point, it makes sense to get incorporated. Some small businesses grow large enough that it makes sense tax-wise to incorporate them. Otherwise, the business income will push you into the top tax bracket. However, this method requires a rigorous cost-benefit analysis. If the cost of incorporating your small business outweighs the tax break that you'll get by incorporating, it doesn't make financial sense to incorporate. Because there are expenses like you have to hire an accountant usually to do your business tax expenses and pay incorporation fees and licensing fees. Number 10 is to contribute to an RESP. Contributing to an RRSP can help you save for your child's education tax-free. While a registered education savings plan or RRSP doesn't lessen your tax obligation right away, it's a powerful financial tool instead of paying for your child's post-grad education with your taxable dollar. Of course, it will still be with your post-tax dollars, but your money will grow tax-free. At max, you can contribute up to $50,000 to an RESP, which is equivalent to $2,500 a year for 20 years. For example, an investment vehicle that offers 5% returns a year can grow your money to $89,000 by the time your child attends school. You will also get $7,200 from the government through matching contributions. The money is taxable when you take it out, but it'll be taxable under your child's name. So because your child will probably be in a low tax bracket, your tax that your child will have to pay will be very little to none. Number 11 on the list here is a classic, and that's to maximize RRSP contributions. RRSP contributions are tax deductible and can lower your tax bill by thousands of dollars or even hundreds of thousands of dollars by the time you retire. Save for your future and maximize your RRSP contributions if possible. It will help your investments grow in a tax-free environment, and you could also lower your tax bill significantly. It's not purely tax-free though, and you will have to pay taxes on it once your RRSP matures and you take it out as an RRIF. When you convert it to an RRF to reduce your tax burden, you could still max out your RRSP contribution if you are earning $151,000 or more a year. If you contribute 18% of your yearly income or $27,180 to your RRSP, you can deduct about $11,800 from your tax bill based on the Ontario tax rate. Number 12 is a classic and the most popular one, I think, and my most favorite is using your TFSA. Used effectively, in my opinion, it could be the most powerful tax management tool you have. Contributions to your TFSA aren't tax deductible like your RRSP, but since whatever grows inside your TFSA and comes out of it is tax-free, if you've accumulated enough contributions, you could reduce your taxable income substantially, especially in your retirement years. For example, instead of withdrawing more than a minimum from your RRIF, you can withdraw from your TFSA and enjoy the benefits of a lower tax bracket because it doesn't affect your income at all. I really love the TFSA and I make it a point to max it out every year. I invest mostly ETFs or stocks inside of it. So my thoughts on paying less taxes is whenever you get the chance to, always pay less taxes. I mean, it's kind of a no-brainer. Of course, there's tax evasion, which is illegal, so you're gonna wanna avoid that. A lot of business owners get in trouble for that. But if you stay within the rules, make sure you take advantage of all possible tax deductions and savings that you can. And once you do save on the taxes, what I recommend for holding your emergency savings, or if you want to grow your savings at a rate much higher than something like RBC or one of the other big banks, I would recommend opening up an account with EQ Bank. They're a great online bank. Currently, they offer a savings rate of 1.5%, again, which is way higher than anything the big banks will offer. So you can check out the link in the description below. I put offer to that. Clearly, there are plenty of ways in which you can pay less taxes in Canada, from using your RRSP to spousal tax privileges and business-related tax breaks. You can push your tax bill to a more reasonable and manageable magnitude. My advice is that you educate yourself and consult an accountant if you have more complex tax issues, or if you have any confusion about tax deductions and credits. Since you made it this far, make sure you like and subscribe to the channel so you don't miss out on any future tips. Also, be sure to check out the blog, wealthawesome.com. It is one of Canada's fastest growing personal finance blogs. I write all the content for it. It goes into this topic in way more detail and also has many other topics for Canadians to look at. And as always, thanks for listening.